US equity futures declined early Monday following the longest winning streak in 2 decades, signaling investor hesitation as markets await further clarity on global trade developments. The pullback comes just as former President Donald Trump hinted that major trade agreements might be announced this week, raising fresh questions about potential geopolitical and tariff implications. Markets had priced in weeks of optimism, driven by easing recession fears and a resilient corporate earnings season. However, the sharp rally, unmatched since the early 2000s, may have overextended valuations, prompting a natural cool-down. Trump's ambiguous reference to potential trade deals injects both anticipation and uncertainty, particularly regarding US-China relations, where tariff escalation remains a credible threat. Analysts warn that vague trade rhetoric, lacking specifics, can disrupt market momentum just as quickly as it builds it. This moment reflects a broader global pattern. Markets are hypersensitive to policy signals, especially those linked to trade, tariffs, and national security. Investor sentiment is being shaped less by fundamentals and more by political ambiguity, a trend likely to persist in the lead-up to the 2024 US election cycle. OPEC Plus shocked markets with an unexpected decision to raise oil output by an additional 410,000 barrels per day starting in June, unsettling global energy traders and pressuring crude prices. The move, seen by analysts as a shift away from the group's recent restraint, risks exacerbating a fragile supply-demand balance. Brent crude futures dropped immediately after the announcement, reflecting investor anxiety over a potential supply glut at a time when global demand remains uneven, especially across China and Europe. The decision comes just weeks after major producers reiterated their commitment to market stability, adding to confusion over OPEC Plus's true strategy. This policy reversal may indicate internal pressures within the bloc, particularly from countries like the UAE and Iraq, that seek to maximize revenues amid fiscal stress. However, it directly contradicts the cautious tone set by Saudi Arabia in prior meetings, suggesting rising divergence within the alliance. Beyond oil markets, the decision reverberates through inflation expectations, central bank planning, and geopolitical energy security, especially in Europe, where dependency on alternative supplies post-Russia remains critical. Warren Buffett has announced he will retire from Berkshire Hathaway at the end of the year, formally ending one of the most iconic leadership tenures in corporate history. After 6 decades at the helm, Buffett will hand the reins to Greg Abel, a longtime top lieutenant and current vice chairman for non-insurance operations. The succession, while anticipated, signals the definitive end of an era. Under Buffett's stewardship, Berkshire evolved from a struggling textile mill into a $900+ billion conglomerate, spanning insurance, railroads, energy, and consumer brands. Abel, often seen as Buffett's ideological protege, is expected to preserve much of the conglomerate's decentralized structure, but investors are bracing for a cultural and strategic shift. Analysts note that Abel's strengths lie in operational efficiency and energy sector leadership, rather than public communication or capital allocation, 2 areas where Buffett built his legend. As such, markets may watch closely for changes in shareholder engagement, deal-making velocity, and risk appetite under the new regime. This transition also reflects a broader generational turnover in American capitalism, with aging founders of major financial and tech firms stepping aside. The question now shifts to how Berkshire evolves in a post-Buffett world. Strategically, financially, and philosophically, shares of Berkshire Hathaway fell nearly 2.5% in pre-market trading following Warren Buffett's retirement announcement, underscoring investor anxiety over leadership transition at one of Wall Street's most iconic firms. The market reaction, though not extreme, reflects a recalibration of confidence as the post-Buffett era officially begins. While Buffett had long signaled Greg Abel as his successor, the confirmation of a concrete timeline triggered fresh scrutiny. Investors are weighing the implications of losing a singular capital allocator whose reputation helped anchor the firm's valuation premium. The 2.5% drop is not merely a technical move. It reflects uncertainty around continuity in investment philosophy, acquisition strategy, and shareholder communication. Berkshire's conglomerate structure, built on Buffett's unique trust-based governance, may face pressure under more conventional leadership dynamics. The market's reaction also fits a broader theme: investors penalizing companies undergoing leadership transitions, especially when the departing executive embodies the brand's identity. In Berkshire's case, Buffett wasn't just CEO, he was the value proposition. Shell is reportedly exploring the possibility of acquiring part or all of BP in what could become one of the energy sector's largest consolidations in decades. The potential move is seen as a strategic bid to capitalize on BP's depressed share price and recalibrate Shell's long-term energy transition framework. With both companies under pressure to redefine their roles in a decarbonizing world, such a merger could accelerate cost synergies, expand resource control, and offer renewed scale in renewables, LNG, and low-carbon fuels. But it also raises regulatory red flags and cultural integration risks, especially given the two firms' historically distinct strategies and public messaging. BP's valuation has lagged behind peers amid strategic missteps and investor skepticism over its pivot away from fossil fuels. Shell's interest, if confirmed, would signal renewed confidence in sector-wide M&A as companies grapple with energy security, price volatility, and capital reallocation post-COVID and post-Ukraine. Analysts warn, however, that absorbing BP could dilute Shell's focus and amplify ESG scrutiny. Any deal would be subject to intense political and regulatory review in both the UK and EU, especially amid rising national energy sensitivities. The new Taiwan dollar surged an unexpected 7% over just 2 trading sessions, prompting Taiwan's central bank to hold an emergency press briefing to calm markets and firmly deny allegations of currency manipulation. The swift appreciation rattled investors and exporters alike as speculation mounted over capital inflows and possible policy miscommunication. Central bank officials emphasized that the spike was driven by short-term speculative flows and not the result of intervention. However, the rapid move risks disrupting Taiwan's export-heavy economy, where even modest currency volatility can erode profit margins in semiconductors and electronics. Analysts warn that without clear FX stabilization measures, the TWD's strength could invite scrutiny from the US Treasury, which closely monitors Asian central banks for signs of unfair trade advantage. Taiwan, already on Washington's monitoring list, now walks a fine line between maintaining market confidence and avoiding geopolitical escalation. The episode underscores the fragility of currency markets in Asia, where tight supply chains, tech dependence, and geopolitical tension converge. In the absence of decisive action, sharp FX swings like this could become the new normal. Currency markets are expected to remain stable this week as central banks in Sweden, Norway, and Brazil face a familiar bind: stagnant growth paired with stubborn inflation. Analysts anticipate policy inertia rather than surprise rate moves, as these economies attempt to balance macroeconomic fragility with inflation containment. This stagflation trap limits their maneuverability. Hiking rates could deepen economic pain, while easing too soon may reignite price pressures. As a result, monetary authorities are likely to maintain a cautious tone, avoiding aggressive action that could rattle foreign exchange markets. In FX terms, this translates to relative calm across Swedish krona, Norwegian krone, and Brazilian real pairs, especially as global investors shift their focus toward US policy direction and Chinese growth signals. The lack of divergence removes catalysts for volatility, at least temporarily. However, prolonged inaction carries reputational risks. Markets may begin questioning central banks' credibility if inflation persists without clear countermeasures. In such an environment, even silence can send signals. Former President Donald Trump has floated the idea of imposing a 100% tariff on films produced outside the United States, a proposal that has sent tremors through the global entertainment industry and cast immediate pressure on streaming giants like Netflix. While no formal policy has been enacted, the mere suggestion has triggered market speculation over trade protectionism targeting creative content. For platforms reliant on international productions, especially European, South Korean, and Latin American content, such a tariff could upend cost structures and licensing models. Industry analysts warn that the move, if pursued, could fracture global media flows and provoke retaliatory measures from other countries. It also raises questions about freedom of cultural exchange and whether entertainment is now being dragged into the broader US trade war narrative. From a business standpoint, Netflix and its peers may face higher content costs, regional supply bottlenecks, or even reduced catalog variety. The entertainment sector, already grappling with strikes, ad slowdowns, and competition, could find itself navigating yet another geopolitical risk. Goldman Sachs and Morgan Stanley have both lowered their Brent crude price forecasts, citing the recent OPEC Plus production hike and weaker than expected global demand as key drivers. The revisions reflect growing skepticism that the oil market can maintain prior bullish assumptions in the face of structural headwinds. OPEC Plus's surprise decision to boost output by 410,000 barrels per day starting in June has amplified concerns of an oversupplied market. Coupled with underwhelming demand in key regions like China and Europe, banks now anticipate downward pressure on oil prices through the second half of the year. Goldman Sachs trimmed its Brent forecast to $78 per barrel, while Morgan Stanley went further, projecting $75 by Q3. Analysts note that recent macro data, ranging from stagnant manufacturing indices to flat transport fuel usage, signal a tepid recovery trajectory in global consumption. This downgrade sends broader implications for inflation expectations, fiscal policy in petrostates, and capital flows into energy equities. For investors, it marks a potential pivot point, from oil-led inflation fears to concerns about growth-led disinflation. Elon Musk has taken aim at the US government, labeling it inefficient and outdated, while proposing that artificial intelligence could replace portions of the administrative bureaucracy. The bold statement, made during a recent public forum, underscores growing frustration from the private sector over what Musk sees as a bloated and underperforming federal system. Musk argued that AI could streamline decision-making, reduce redundancy, and inject speed into systems hampered by inertia and legacy processes. While he did not provide specifics, the implication is clear. Automation and algorithmic governance could outperform traditional bureaucracies in both cost and efficiency. The comments sparked immediate debate across policy circles. Critics warn that introducing AI into the public sector without accountability frameworks could backfire, amplifying bias and reducing transparency. Supporters, however, argue that technology has already outpaced institutional response times, particularly in crisis management, permitting, and data coordination. Musk's remarks align with a broader narrative. Private tech leadership is increasingly vocal about the need for systemic reform in governance. As AI tools become more sophisticated, the tension between innovation and regulation will only intensify, raising profound questions about control, accountability, and public trust. Former President Donald Trump stated that new trade deals may be announced within the next 2 to 3 weeks, reigniting speculation about tariff escalation, particularly against China. Speaking to supporters, Trump emphasized the US's persistent trade deficit with Beijing and floated the possibility of additional tariffs as a corrective measure. The remarks, although vague in detail, reflect a familiar playbook, using tariff threats as both leverage and campaign messaging. With the US trade deficit with China still exceeding $300 billion annually, Trump's rhetoric strikes a chord among protectionist voters and industrial lobbies. Markets remain cautious. Investors recall how past trade tensions under Trump disrupted global supply chains, weighed on equity markets, and prompted retaliatory actions from China. A re-escalation of such policies could undermine fragile post-pandemic trade normalization. Strategically, the announcement window aligns with the political calendar, suggesting that trade may once again be used as a geopolitical wedge, both externally and domestically. The threat of new tariffs also complicates planning for multinational corporations with exposure to China. Donald Trump has claimed that China wants a deal very badly, implying that Beijing is under pressure to resolve ongoing trade tensions. However, despite the rhetoric, no tangible progress has been reported in high-level negotiations, reinforcing doubts about whether real breakthroughs are on the horizon. Trump's comments appear designed to frame the US as holding the upper hand, yet insiders note that bilateral talks have remained largely inactive in recent months. The lack of formal engagement between senior officials signals a possible disconnect between public messaging and diplomatic reality. From a geopolitical standpoint, China may be deliberately waiting out the US election cycle, preferring to negotiate with clarity on leadership continuity. Meanwhile, businesses reliant on cross-Pacific trade remain in limbo, caught between aggressive rhetoric and a vacuum of concrete policy. The broader takeaway, headline risk remains high. Until formal talks resume at the ministerial level, any optimism rooted in political soundbites should be treated cautiously by markets and multinational firms alike. A series of critical updates from central banks and energy authorities, including the US Federal Reserve, Sweden's Riksbank, Norway's Norges Bank, Brazil's Banco Central, and the US Department of Energy, are set to shape global financial markets this week. Traders are positioning defensively as policy signals, and data releases could trigger sharp moves across currencies, rates, and commodities. Markets are especially attuned to the Fed's tone post-inflation data, amid diverging views on whether further rate hikes are warranted. Meanwhile, Sweden and Norway must navigate weak growth and sticky inflation, with investors watching for subtle shifts rather than overt moves. Brazil's monetary stance will also be scrutinized as it battles persistent currency volatility. On the energy front, the DOE's upcoming inventory and production reports will test market sentiment following OPEC Plus's recent supply increase and revised oil demand outlooks from major investment banks. In short, this confluence of macro signals arrives at a time of heightened sensitivity, where even modest surprises can ignite volatility. With liquidity thin and conviction low, cross-asset correlation risk remains elevated. Jack Caffrey of JP Morgan notes that investors are increasingly abandoning long-term positions in favor of short-term tactical trading, driven by hypersensitivity to real-time data and heightened macro volatility. This shift underscores a structural transformation in market behavior, where patience is replaced by reactivity. Gone are the days when investors waited for quarterly earnings or central bank meetings to recalibrate exposure. Today, market participants react within minutes to inflation prints, labor data, or geopolitical headlines, reflecting a transition from conviction-based investing to data-triggered execution. This behavioral pivot has led to thinner liquidity, more algorithmic flows, and an increase in intraday volatility. Hedge funds and institutional players are shortening time horizons, favoring optionality and flexibility over long-duration risk. The broader implication is one of market fragility. When everyone is watching the same data and reacting simultaneously, feedback loops intensify, creating the conditions for sharp reversals, flash crashes, or exaggerated momentum. Global deflationary signals are becoming harder to ignore. With oil prices sliding, consumer demand faltering, and spending momentum cooling, the macro environment points toward weakening price pressure. Yet, in sharp contrast, major tech firms are ramping up capital expenditure on artificial intelligence, defying the broader economic slowdown. The deceleration in demand is particularly evident in retail and services data across developed economies, where consumer sentiment is weighed down by sticky inflation and high interest rates. This weakening backdrop fuels concerns about a deflationary undertow, potentially complicating central bank policy. Nonetheless, tech giants including Microsoft, Google, and Amazon are pressing forward with multi-billion-dollar AI infrastructure projects. Their investment thesis, AI is a long-term productivity driver immune to short-term macro fluctuations. This divergence signals a bifurcated economy, softening fundamentals in traditional sectors, yet aggressive innovation-led spending in frontier technology. For investors, it presents a paradox. Do you follow macro caution or the AI capital cycle?